Then go ahead.
Okay. Yeah, recording in progress now.
All right.
Okay.
So thanks everyone. I think today we have probably Shaiju as a new member. Shaiju, this is the first time you are attending, right? And we also have Ram Babu. Yes, Shaiju. All right. Anyway, yeah, Manish, you can go ahead as per
Yeah. Yeah.
your plan.
So
Yeah, just go ahead.
wonderful. Thank you, everybody. And this is part 2 of the previous session, that the concepts of my principles of value investing. And just like I said before, this is just whatever my learning and my experience is, I'm sharing. There is nothing like right or wrong. Um, so just feel free to interject if there are some things you think otherwise, right? And it is just like, let's take it more like a approach way. Okay, so let me go to the disclaimer here. So the disclaimer again, same, that I'm not a registered investment advisor, and I'm not expert also. And whatever discussion we are having, it is only for learning perspective. And the stock ideas which are shared, those are only for learning perspective. Okay, so today agenda, I tried to keep it simple because we want to wrap up like in like less than 1 hour. We are trying for last 2 3 times, but every time we are failing. So hopefully today we can do that. Okay, so straight away going into the, so last time we discussed that what are the things what are the things we need, basically, like to understand the valuation. We divided in like 4 or 5 parts, and then we said, okay, so if there are like we need to understand the company, we need to understand the business, we need to understand the macro environment, and uh, and the economy, basically. So, and then the valuation parameter was the first one. So if we do all these things, then basically we can evaluate a company. But now we want to understand even more just the evaluation part. We are not much talking about the business, about the macro, just the company evaluation, how we do. And to understand, we need to understand the mindset of evaluator. So if we are a evaluator, right, then what mindset we should have, then we can approach the basically evaluation in a better way. So for example, like if you see, just 1 second, some people waiting in the room. Yeah, Siva, if you see somebody waiting, can you let them enter? Or is there some setting which had happened maybe this time? Okay,
Yes, Manish. I just reclaimed as a host. Now I can do that. Thanks.
okay, okay. Thank you. So now, yeah, that is the mindset we need to understand, we have to be in to evaluate the a company. Okay, what do we want to do? Then automatically we will be able to find the parameters we need to assess for the company to get to evaluation. So a lot of people maybe in means now it is not a lot, but previously I think even now it is happening, that when we have a daughter or a sister in for ready for marriage, we go to uh, bridegroom place and we want to assess the relation, like, okay, so what does he do? And then basically you see that what are his earnings, how economic stability the bridegroom is, and the how the family is, and how their behavior is. All those things we assess, right? Economy especially we do that, right? And we have to take that same approach, that we have to like consider that, okay, that dowry is like a good thing in this kind of, just for these couple of slides. So if you remember, like you go to a house and you see, okay, this is my son and he is ready, we are ready for the marriage, and this guy does this, he earned this much money, and we have this much of wealth, and dowry, oh, we are expecting this much dowry. So generally, you will see the relationship between what they have and how their economic stability to the dowry, right? The similar way we have to do here for the companies, right? Because you pay your money and for your financial well-being, right? Same way you do that for your sister or for your daughter, for her well-being, for her financial freedom. You pay some money as a dowry, and more money you pay, often it generally is not 100%, but often you get better relation, better better economic stable family, and better economic stable bridegroom, right? So let's assess the scenario here. So we have this bridegroom one, he doesn't do much work, he just sits home, okay? And but he has a big house, like 5 crore worth of house, and maintenance expenditure of this house itself is, let's say, 2 lakh rupees a year. Then he has a lot of land, and the land, basically, he cultivates on his land and make money from that. uh, that is yield is only 10 lakh. Generally that is how the land yields are, like 5 crore land, but it yields 10 lakhs. And then he has a car which is 50 lakh rupees car, and the maintenance expense of the car is 1 lakh, and there are other expenses also 1 lakh. So this is how you go and you see that, okay, so, oh, this guy has this much money, and then his earnings are, so how do you calculate the earning? And they are asking like a dowry of 3 crore rupees, right? But now you have to understand, it doesn't make any sense to do that. So if you see that how much is the earning, 10 lakh rupees come only from here. This house is mostly expenditure, luxury or something you can say. And then there are other two expenditures. So these are like big level expenditure. So once 10 lakh comes, then minus 2 lakh here, minus 1 lakh here, minus 1 lakh here. So he's earning home, the earning which is coming to his home, like to his family available, is like 6 lakh rupees. Then if you see what is the book value, on the book he will have 5 crore worth of, let's say, house, 5 crore worth of land, and then there is a car. So it is very high level, just illustration purpose. It means like the book value in companies are calculated differently, like this like there is depreciation involved. But here we can just say, okay, so this is high level book value. Let's assume it is registered today, right? So he has 10.5 crore rupees. So if we go for the ratio price to earning, which is very popular ratio, I hope everybody knows that. Price to earning is means like what is the price you are giving for the stock, and what is the earning. The price to earning will come very high, like 50, and price to book will come very small, zero point 0.2, right? So this is one kind of scenario. You go to this house and then you think, oh man, like this guy doesn't do anything, but he has a lot of money, he has a lot of wealth, but he's asking like so much money, right? So that is where but like this kind of company, not easy, basically, not easy to basically decide whether we want to buy them, right? Now you go to another house and you see this, oh, this boy is a navy officer, he earns 20 lakhs per annum, but he has a government apartment which comes on very minor salary deduct, so almost free housing, but it doesn't belong to him, right? And then he has just a one fixed deposit of 5 lakh rupees. So now if you look at this guy and you say, they are asking for 1 crore rupee. Okay. So now if you see what happens is earnings become 20 lakh rupees, book value becomes only 5 lakh because he has only 5 lakh deposit, nothing else. So in this scenario, the PE becomes like 5 only and PB becomes 20. So price to book become very high, right? So they are like IT kind of companies where PB is very high and PE is also very high. Like let's say this tag was like 5 crore rupees, then this would PE would be 25 and PB would also be very high. It is like that kind of scenario. So a lot of people like they say, oh, this growth investing versus value investing. But if you see like in these two scenario, both can be evaluated properly. So given the scenario, like in this scenario, like if I ask people what they will prefer, this one or this one, like what would be the general tendency of people?
I would like to go for second, sir.
Second one, okay. Yeah. Anybody else?
Yeah, general tendency like Manish, yeah, the first one many people prefer because they see a lot of assets. Yeah, yeah. Even though if you don't do, no problem. Something the general
Yeah.
tendency, but when you come to check, I think the monthly salary or whatever monthly income and P by B ratio is the greatest thing to select actually, if they are wise people.
Yeah. So yeah, so here the income is the issue basically, right? So there is less income involved, and here like future wealth is not much there. Like this guy, once he retires, he will have his provident fund, and then what will he do, right? So I would say that if we have like this kind of company or this kind of company, we don't like I would strive for something better. So what I will strive for, I will strive for somebody who has all. Like what is the problem if there is a navy officer who has land also and who has house also, right? So you can get that, like you can have an you should strive to find those kind of scenarios, right? Where there is a navy officer, now he gets 20 lakh rupees per annum, then he has house, he has land, he has car, and he has, in the city he lives in government apartment, but in the village he has his house, he has fixed deposit also. And now if you look at his earnings go up, his book value is still almost same. So now his P ratio also becomes very lucrative, right? Because I still keep the tag 3 crore. But if you dig harder, like if you like a lot of people like they go for only 3, 4, 5 uh, houses, and they're only they see the relationship. But there are people who struggle for 2, 3 years, and then they visit like 100. And if they visit 100, they are able to find such kind of deal where they they can find the guy like this. At the same time, they can drop the price tag even further. They can we try to reduce the dowry further? So like this price tag from 3 crore will get down to like let's say 2 crore, right? So that is where that is how basically you manage to basically get a more economic strong family for giving lesser of your money. And that is the mindset we have to approach this, right? So so now moving to the next slide, let's say, so here if you see in this scenario, the things are simple in a sense, because if you look at it, you know that a Navy officer, the job is permanent, right? And normally these guys have good retirement benefit, they have good kind of life, all these things, all you needed to know only the salary, and then rest of the things just fall in place. You know how the fixed deposit work, you know how this government apartment arrangement works. On this side also, like a lot of people, they will just look at the house, they'll say, oh, this house is like 5 crores, yeah, very well, okay. And then how the land works, how the yields are. So each of these things we know here, right? So it is just getting the number, and then you can evaluate how much you should pay for the dowry very quickly. But what will happen, let's say in this case, let's say if this guy is a businessman, then it becomes little difficult. So if the people who have experience of this, like they go for matches for their sister or daughter, they know this like very well. If they go to a businessman house, it's very difficult to understand the economic stability of the house. Because let's say this guy has a business, right? And now the business was like, they will say, his father will say, oh, this guy took 10 crore from me and started the business, right? And then companies is still making losses. There is just some cash flow coming, but company in profit and loss wise, they're making losses. It will make money in future, but there are debts also for 5 crore rupees, and they are able to service the debt. So which means like the business is genuine, it is running well, right? But now you don't know what to do, because all those ratios are not clear. Because and and the positive thing about business is like all this house and the car and all these expenses are paid by the company, so that is one relief there. Now here what happens, your earnings become negative, and book value is, let's say that he put 10 crore rupees, let's say, just take on the book, because now you don't know the book value too, because in 3 years, if he made money, book value will increase. If he lost money, the book value will go down. So for a simple calculation, you can put 10 crore minus 5 crore is like 5 crore only. So book value becomes only 5 crore, right? But P, because it is negative earning, P is not meaningful. PB, it is like 1 crore divided by 5 crore become 0.2, but this also becomes not meaningful. The reason is we do not know what is the book value, right? So here this scenario becomes difficult. And so to know, like some to understand this, we need to know how the business works. So like you have to ask, okay, so what business he is in, right? And then you have to see this. You most of the people will go and talk to somebody else who is in the same business, and then they will say, okay, this guy does like this and he has this big shop, and then do you know him? If, no, I don't know him. Okay, then okay, he has this much of inventory, and his shop runs like this, like all these things you explained, then probably he can tell what that whether the guy is making money or not, right? And uh, and at the same time, you should also have a clear view on how the business is going to do in future, right? If somebody is having a business which basically is like anyway going to decline, like somebody is like in a typewriter business, so typewriters are going out of fashion very fast, right? And then the demands in future is going to go down, so of course what kind of business he's in, right? So you understand, you have to know something about the business also. And then you talk to the guy, and he has to understand the business, he has to tell the plans, what he wants to do and how he wants to achieve. And so it becomes more complex scenario. That is where the valuation become very difficult. Valuation of doing Amazon and Google are very difficult to do, because they don't have, let's say, positive earning. Now they have, but like, let's say 5 years back, and now there are other companies like Zoom and all these software companies. It becomes difficult because their earnings they don't have, so you go on free cash flow or sales, make the valuation, and then it comes very high multiple, but they say, oh, all the money will make on in future. Like if I today I say, oh, a SpaceX, like how do we value the company, right? It is like they are saying it is valued at $100 billion. Okay, it is valued at $100 billion, but how, right? Somebody is saying no, it valuation can be 1 trillion to 5 trillion in future, right? So because they don't have earning, and they don't even have books also, because they, let's say they don't have big plans, right? And they are asking for $100 billion. So only the person who has very clear of understanding how the business works, or where the future of space travel would be, that they only can basically make a good call. Otherwise, we are, if somebody asks me to invest in Facebook, it is very difficult for me to be comfortable with the valuation, because I know I do not know the business, right? And the financial parameters are not there, they are not meaningful, because they don't have earning, they don't have book, they don't have plans, they have just some plans, right? so so I think most I hope all of us understood, like what is the generally we in, like when we are evaluating the company, what kind of thing we are looking for, right? Okay, moving to the next slide. Okay, yeah, so this thing I forgot to mention, the bigger possibilities are in these scenarios. So if you get a company which has a big land bank, and and then you say, oh, this company has 1000 crore land bank, and this has offices worth 500 crore, is 1500 crore, and then it is available for 500. That kind of deal you can find in the market, but they are not going to make a lot of money for you. But in these kind of scenario, the opportunities and risk are very high, because this business, like which is 10 crore rupees, it can be 100 crore in next 5 years, right? Or this all 10 crore would be gone also, right? So here it is worth spending time and money to look at it, look at these kind of scenarios. So key key metrics and terms and ratios. These ratios, at least we have to all know and understand the meaning of that, right? A lot of people know the ratios, but they don't understand what it means actually. So we have to try to simplify in our brain, right, that what it means. Okay, so market cap, we understand what it is. Like when you open a company, right, you issue shares, and initially at the beginning of the company, you just give the face value of the share, like 10 rupees a share, and then you issue like 1 lakh share, then it becomes 1 crore, then market cap becomes 1 crore. But when you basically do the business, then every year you make money, right? So what happens that your initial money, like 1 crore, plus every year, let's say you make 1 crore rupees, after 5 years you make 5 crore rupees, right? So 5 crore plus 1 crore, that is 6 crore. That becomes shareholder equity. Then you can take that shareholder equity to the market. Let's say you go for IPO, and in IPO you say that, okay, my shareholder equity is only 6 crore, but I'm offering 25% of my share for 60 crore. So that becomes 240 crore valuation of the company, right? So that 240 crore, that will become the market cap. And then you have 1 lakh share, 10 lakh share, let's say you have issued, right? And then 10 lakh, you divide that by 10 lakh, and that will come your share price, right? So that is a simple calculation. We have to know this market cap is very important to understand. I do all my calculations based on market cap, not on share price. because market cap inherently gives you a lot of sense of the whole business. Share price doesn't give that. So what is shareholder equity? Like these are two equations, both are same. Contributed capital, which is like at the beginning of the company, which you put the money, like face value times number of share, plus retained earning. Okay, and it the same can be called as asset minus liability. It's also called shareholder equity, and it is also called net worth of the company. Okay, what is PE? PE to me, it is price to earning, and I calculate always with market cap divided by profit after tax. So final profit, okay, market cap to final profit. Okay, it is not operating profit, not EBITDA, not EBIT. It is final profit after tax. PB, so PB is price to book, so it is market cap to the shareholder equity. If you do, you will get the PB. Okay, so the shareholder equity, you know this. So this divided by this is price to book. EV, what is EV? EV is enterprise value, is market cap. So whatever the market cap of the company, like it, what is trading at, plus the debts they have, and minus the cash. So EV becomes very important when you are comparing a lot of companies on some ratios. So EV ratios are very helpful, because what they do, that they nullify the debt factor. So let's say I'm comparing company A, company B. Company A doesn't have any debt, and company B has some debt. So company A is making money using the shareholder money, where company B is little bit leveraging. They are using shareholder money plus plus debts also, right? So obviously company B, which is using more money, should make more money also, right? So if you do the ratios analysis based on only market cap, you will miss that, and their ratios will come better. So EV nullifies that. So EV EBITDA, if you do for the companies, you will see a lot of companies will come very close based on the business. Like if you look at the EV EBITDA for cement companies, they will come very close, a lot of. So, but if you do on other parameters like profit margin or this thing or that thing, and market cap, they come a little different. Then debt to equity ratio is how much debt they have and how much shareholder equity they have. Okay, so this is also, so you see the debt parameter is linked to the equity, okay, not linked to the sales or profit or something, because debt is a risk part of the business, because let's say that when the debt is due, you will always give it from your shareholder equity, from your treasure. And what is your treasure? Your treasure is shareholder equity, right? So always is most of the time all the debt things would be linked to the treasure, not your day-to-day operating income like sales or EBITDA or profit or those things. Then ROC. So ROC and ROE and ROIC and so ROC is return on capital employed, ROE is return on equity, ROIC is return on invested capital, and there is another return on net worth, return on net assets, they call it RONA. So all these parameters are basically, they are very similar, but some people track differently. Like if there is a company manager, he will always try to say I will look at RONA, return on net worth, because what he is saying that I have so much, which is very similar to return on equity, right? And that I have in net, I have so much money, and on that how much money I'm making, right? ROC is like how much total capital employed you have, which means what is total capital employed you have how much money you are making on that. Okay, so for example, I have my company has as a shareholder equity has 1 crore, and then we go and borrow 2 crore from market, so like from a bank, right? So 1 crore of my money and 2 crore of my money, so it is like 3 crore rupees I have. On 3 crore I make, let's say, 50 lakh rupees. So 50 lakh rupees, and only one thing is here, it is EBIT, so it is minus interest and tax, right? So why EBIT becomes important here? Because it is already considering the debt. So interest it is minusing off, okay, and tax also it is minusing off to find the efficiency of the money, right? So so let's say I'm making EBIT of 50, so 50 divided by 3 crore would be times 100 would be my ROCE, right? So it will become 20% ROCE business, right? What is ROE? If I ask you, then you have to see, okay, my EBIT is 50 crore and I pay interest, let's say 10 crore rupees, and I pay tax of, let's say, 15 crore rupees. So 50 minus, sorry, 50 lakh, 50 lakh is my EBIT, and 10 lakh is my interest, and 15 lakh is my tax. So it becomes 25 of PAT, which is net income. And my equity was what? 1 crore. So 20 lakh divided by 1 crore becomes my ROE. So ROE becomes 20%. So it becomes ROE. So ROE is how much company is making on our shareholders' money. So I look at both, and most of the time these numbers are close. Okay, like if it is a debt-free company, this number would be very close, right? If there is a heavy debt company, this number would be a little more far off. Okay, and sometimes if it is heavy debt and it is a high interest rate serving debt, then this number can even be lower, which actually it should be higher, but if the interest cost is is too much, then what will happen? Sorry, then this number would be not higher. Basically, then the impact will be, the difference will go even higher. So it is the debt plus the interest will basically diverge these two numbers. But generally, if it is debt-free company, you will find these two numbers very close, and these two are good enough to evaluate any company. Okay, now we look at this free cash flow. So this is another important parameter to look at, free cash flow. So it basically tells the health of the company. Like if from the operation of the company, let's say you are getting 10 crore rupees, like 1 crore rupees, let's say you are getting 1 crore rupee as a cash you are generating, and then you say, oh, I need to spend 2 crore on the expansion of this thing, or fixing of this fixing of this plant. Then 1 crore minus 2 crore becomes minus 1 crore. So free cash flow becomes negative. It's not a healthy sign, which means like going to previous example, like the father is saying that my son, who is basically ready for marriage, is every year he is putting, like 3 years back I gave him 5 crore 10 crore rupees for putting in the business, and he is every year is still coming for, oh, give me 1 crore, and I'm giving him. And then again last year also came 2 crore, and then 1 crore rupees, and then he's asking 1 crore rupees. It is not a good sign. If a business is basically, after establishing and after a few years of running, it is not generating free cash flow, is not, it is not a good sign. You have to find out why it is not generating free cash flow. Where is the problem, right? So because they are putting up, like if they are, like it is uh, like your salary is like 1 rupee and you are spending 2 rupees, it is something like that, then you can be in financial trouble very soon. So a lot of people love high free cash flow companies. High free cash flow company, they never get into trouble. And if you see, they are often valued much higher, much richer valuation. Then current ratio. So this is the ratio is for the financial health. Current asset divided by current liabilities. So basically current asset generally is like cash or cash equivalent, right? So and then current liability is like whatever is like short-term debt is ready to due. So it is obviously like even in our house we can run this ratio on us, like what is the current assets we have. We can look at, oh, I have 3 bank account altogether has 1 crore rupees. And then what is the current liabilities? My EMI for car is due, my EMI for house is due, and then the school fees is there, and then the regular expenses for next 1 month. So for short term 1 month, you can have your current ratio like, okay, so I have total 1 lakh rupees, and all these EMIs and these expenditures are 1.5 lakh rupees. So my current ratio goes less than 1 is not a good sign, right? It should be always more than 1. So whatever liable the money you have to pay in near future, you should have more cash ready for that always, right? So current ratio higher than 1 point, like like one is definitely needed. Generally I will say, okay, make it 1.5, make it 2, so something like that, just to be very sure and comfortable. Quick ratio is also very similar.
Manish,
Yeah.
sorry, let me just maybe just clarify something if since it's going on a flow. So regarding the current ratio, right?
Yeah.
So like you mentioned, it can be a good financial indicator on where the company stands in managing the regular cash flows. Uh, on the other hand, right? Please correct me if I'm wrong. If the company is managing as long as the company can manage its cash flow, for example, it has a adequate free cash flow, and if they have more account payable than the receivable, right? So that means account payable is, let's say it's more, the current ratio is basically going to be very less. So in other words, when the account payable is more and the current ratio is small, that is also one of the objective which the companies strive to achieve, which can give them more free cash flow. You get what I mean?
Mm-hmm.
When you're looking forward for a good free cash flow,
Yeah.
an operating company will try to squeeze as much as possible uh, that their current assets are very less and current liabilities are more. Then they will get more free cash flow. This is like for a simple business, it is like getting overdraft, bank overdraft to pay the debtors, and they need very less cash, so the free cash flow is higher, and also the ROC is also it will boost the
Also,
ROC.
yeah, it will boost the ROC. Yeah. So that is where then you'll have to look at the total debt to equity will jump, right? That is what we do, right? Generally, what happens when the loan is due for this month, you go and to pay that and take another loan, right? So what do you do? Like the
Yeah,
short term liability, you reduce and push it in future, right? So
yeah, that's right. So as
and
long as it's manageable, they are efficiently managing.
yeah.
It's okay, right? It's like a pinch of salt. We can't directly conclude
No,
that
you
if the
cannot
current.
directly conclude any of these ratios. Everywhere you have to find what they are trying to do,
Okay,
right?
all right.
So that is where this ILFS crisis happened, that they tried to do all these kind of things which you are saying, that they are pushing the liability too much in the future. But it after a point it became unmanageable, because what happened when they have this kind of track record, their interest went up. suddenly, like then you are managing like taking a lot of risk, right? Because let's say that you have a lot of money as debt, right? And it is in future, and today the debt is like at 1.5%, and tomorrow it becomes 3%. So suddenly all your parameters will go haywire, and that is what you are seeing in a lot of these companies today in US, because these guys did not have earnings, and whichever has even little bit debt, it is being punished a lot, because they know that interest rate for 1 year back it was less than 1%. Now it is 2%, 2.5%. If it becomes 3-4%, it will affect them very badly. So we need to look at the trend, what they are trying to do. If the
Okay,
company is
thanks.
pushing too much of their current liabilities in future, they are just kicking the can down, and one day it will happen. So even in our finances, right, like we do that, okay, roll over the debt to the future, but like everybody has the rule, like not more than 3 times of my regular income, not more than 4 times, right? But but if we make it like 40 times, then we know it is going to give us trouble, right? So
Thanks.
yeah, no problem, thanks for asking. And quick ratio is also another something very similar. It also says cash plus receivable plus divided by current liability. So very quickly it gives you what is that called, a sense where companies stand. Like this ratio became very important in 2020, when this COVID crisis came, and a lot of these cruise companies, airline companies, were like trading at very low valuation, and then people were jumping. But the wiser people, they look at this. The reason was that we know that these companies will not make any revenues, any profit in next 1.5 year. So for next 1 year, do they have this more than this? If not, they can be in big problem, right? So that is why all these companies, they rush to the bank and raise money at like 10%, where the interest rate were like 1 or 2%. So they save the company, but now now that 10% will bite them back. So now if you see that when the reopening happened, all these stock jump like anything, and then after that they are just there for like 1.5 year, they are still there, because even if their scenario improved, but to manage their debts, the debt they took at so high interest that it is eating away their profit. Yeah. Okay. Then asset turnover ratio. Okay. So not in all kind of businesses, but in sub businesses, when you are comparing the companies, it is important. So what does it say? That today, if I give you 1 crore rupees, right, and then you say, oh, I want to start the business, how quickly you can make turn into a sales, right? In 3 months, if you can turn into sale, that is a good sign. Like that means your asset turnover ratio becomes like 4x, 4 times. So like 1 crore rupee, you turn over in, you make it in sale, you make your product and sell it for 1 crore, then you get that 1 crore. From that you make the stuff again, and then you sell it again for 1 crore. So you can do cycle like 4 cycles in a year, and that becomes like 4. That is very, very good, because like nobody likes that I give that, I give 1 crore rupee, and then you take 2 years to make it sales, right? And then because that then the profit would also not come. But in like banking kind of thing, it doesn't matter, because in banking is different business. You give the money for long term, and then you have to also understand the accounting. Like if a bank gives loan to somebody of 1 crore, that 1 crore is not called sales, right? Because that is like they are paying. The sale is basically the interest they get, the fees they get, that is only sale they have. Sale and profit is calculated derived from there. So that ratio is not meaningful for the banks. We need to know what kind of business, then we can see which ratio I would like to apply. Yeah. So last time I
So
yeah.
sorry, just so yeah, just to recap, whatever you talk in this slide, right?
Yeah.
Almost 90% are not applicable to bank and financial business, right? It's a very generic rule.
Yeah, it is. Yeah, yeah. So like, this is very important to bank, and this is important to bank, and this is important to bank, and yeah, yeah. And then all these other things are less important, but definitely this is ILFS issue happened here. So, so yeah, I think selectively means like half of this would still apply, but some would be very
Okay.
strong, uh, very strong applicability. Some of those ratio will have. So last time when we were talking, we said that okay, I said that for each businesses, if we understand the business, we should be able to derive 2 or 3 financial parameters which we are looking at, right? So today, I think I will talk some of those. So to get a little more understanding. So let me see. So like logistic business. So this is one of my biggest holding I have. So I put it. So when I'm investing, what do we do is I look at why I want to get into this kind of business, and then look at the companies and compare, right? So logistic is a very high mode business. Okay, like it is like not any XYZ guy can come and today replicate it. Very high mode business, and it has a strong link to the economy and progress of the country. So the linking of the logistic business is very good because they move the things around. So they are very much relevant business for the GDP of the company. If logistics like today, any hartal happens, a strike happens, logistics is down, the GDP is directly impacted, right? So, and there is a ratio on the logistics company also, that if a GDP, like in the positive side, if your GDP is, if GDP grows at 5%, the sales of a good logistic company will grow at 10%, and the profit of the logistics company will grow at 20%. So it is two times. So it it has a good economy of a scale. So almost every business we should look for economy of a scale. It's very important that if I increase the sale 2 times, my profit should go up 4 times. I don't like the businesses where the company is doing only like a 2 times sales, 2 times profit. That means they are not achieving and not achieving any great results from the extra sales you are getting, right? The so so on these business, once I know this, I can look at the companies and I look for these parameters mainly: how much capital, how much money they are making with the capital capital we are putting in, low debts, and track record of economy of scale, right? So what is the track record they have? So for example, if you let me take this here. Just 1 second. So let's go to the screener, right? So once I say that, okay, I want to go for logistics, I will go and take a few logistics company. So it is TCI, let's say, right? So in my screener, I have all these parameters already set in, which you will see. So now if I go, this is my top holding, and then TCI Express, let's say, another logistic company. It is the this is the parent and this is child became bigger than the parent. And then let's say that you guys feel free to give any name. Okay, so one name I always see is there is Mahindra Logistics, and then you can put any other name. Let's say, what is that,
Raja, there is one in Tiruchur, right? What is that? Do you know that? Near to MRF. I always was keen in this.
Mm.
Anyway, no mind.
There is, yeah, all cargo is there.
Al Cargo, yeah, Al Cargo, yeah, correct.
All
Correct.
cargo. So a lot of people talk about this. So now if I compare here, so if you see, this is the market cap of the company. So this is like in 5,500 crore, roughly 7,200, and then this is 4,000 crore company, and this is 8,600 crore. Okay, so look at the PE of the company. See, very high PE for this one. And every time you open any TV channel, they are talking about this company. But and you will seldom see anybody talking about this company. So that is where I say often the opportunity is where the news anchors are not there. News anchors and the analysts and those guys are not talking, right? Often the opportunity is there. So you see to here. Then if you, so the profitability wise, this guy is better. Look at the dividend yield, also it is better. ROCE, you see. So now if you see here, ROCE and ROE is not much different. Okay. So either their debt is very low, or it is the interest payment is also very is basically also affecting the calculation. You'll have to see
So
that.
is there any range we have to see for the ROCE, sir? Like
No,
this
it
is
depends
maybe
on
54.
business. Yeah, it tells about business. Most of the businesses are
No, no. For
basically,
example, this TCI of India and TCI Express, if you see the ROCE is here is 14.6 and here is 33.89. So which will be the best, sir?
yeah. So they so this means this company takes very little money to make money, right? So if I give 1 crore to this company, it will make like a 15 lakh rupees. And if I give 1 crore to this company, it will make 33 lakh rupees, let's say, right? But what you have to again see, it is reflecting in the PE also. So, but this company, if I want to buy, he is saying, give me 5 crore, and this guy is saying, give me 2 crore, you know. So I can buy this company for 2 crore, and I can buy this company for 5 crore.
Right.
So you have to see, is it worth it? It is already in the price, right? So this
Right.
efficiency, high ROC efficiency is already in the price. So that is why I'm saying, you if you look at isolation, this company will look very good here. If you look just here, this company will look very expensive, right? This will look, oh, very cheap, right? Here you see is very expensive. So now here, if you see, so this is the opportunity you will see to dump this company. Today I don't want to look at this company, because you see ROC ROE are different. So something, there is some issue in the, I think that they may be heavy on debt or what. We have to see the calculation more. But if you see, it's very high PE also. So it means market is anticipating that there is a lot of money coming in future, right? Where here the money is already in here, right? So this become a better deal. And now if you look at here, this is low, and then the PE is same. So this company becomes in between of this. And now if we further go down, so ROC ROE is important. Debt, yeah, so debt is important. So now you see debt to equity 0.1, and you see 0.47. So this is the reason you see there is a big difference. It is just 0.1 debt. This one doesn't have any debt. And you see the P is like 20, and P is 110. So like these like obvious answers are available in the, when we do these kind of comparison. ROC average. So I say, like, look at the track record, right? So why I look at the track record, I look at these at least 3 years. If I make it a ROC for 10 years, then what happens? Then you make the equation very complex. It may happen that the company had made very good ROC before, and now it is not making. So I think 3 years to 5 years is a good range basically to see the track record, right? Then the dividend payout, here it is more because they earn very little money and then they pay some dividend. And this is the historically PE is also, if you see, it is low and this is high. So historically, this company, the Mahindra Logistics, is a very popular company, right? Interest coverage ratio, you see, this company is in danger. Like it's like 3. So like if every month interest is due 1 crore, it is making only 3 crore rupees. Not a good thing.
What, so can you explain most of the interest cover ratio?
So like this company has debt, right? So on the debt, uh, you have interest. So let's say they have 100 crore debt and it is on 10%, let's say, or 15%. So every year you have to pay 15 crore rupees on interest only, and there would be some repayment also. So if you are making 50, you have 50, like 10 crore every year is due, and you are making only 13 crore. So it's not a healthy sign, because you have very little money left out for your other things. So 30 crore you are making, and then then you have only 20 crore left, where this company can service the debt. Like so why that become important? Let's say suddenly something happens and they lose earning totally, right? Then this company can survive for less than 3 years, but this company can survive for 20 years on just 1 year of earning, right? That is how it is basically understood. Generally, higher interest coverage is always better. So interest last year they paid this much, they paid this much. So this company is making lot more money than what interest they are paying. So they pay 20%, but they are making only little money. And operating profit, you can say net profit, okay, and then what would be the bigger one? So promoter holding also, like it's better to see, like generally if it is higher promoter holding, it is a good thing, because promoter will not make bad decision for himself, right? Now you see EV EBITDA. So EV EBITDA, if you see, generally they should be very close, but here if you see, yeah, here it is so this becomes totally different kind of business. Actually, this is more like Blue Dart and DTDC kind of business, and this and this and these are very comparable companies. So here I think the debt is a big factor in here, and the operating efficiency of this company is also not good. So once we get that from here, that's why I say, like, doing this thing takes very little time, right? But after that, further we need to find out what is happening, right? Further we need to find out why it is like that. So that is where it takes a lot of time to understand. Like, yeah, like if you go and find about this company, what kind of businesses they are in, you will find, oh, this why it is Mahindra Logistics. I think they have 50% plus business, just Mahindra automobiles, and then that business they handle more than 50% is from that company. So it becomes a risk factor too, because if Mahindra sales goes down and let's say Tata Motor and Maruti literally give them hard time, this company is automatically affected. So any company which has like a single client, or a client with like 50% plus sales coming from one client, is not a strength, it is a weakness. So yeah, so trade receivables and trade payables. So this is not good for TCI. It seems like people are not paying them money very quickly, where they are paying to their vendors very quickly. Here it is opposite. They are not paying to their vendors very quickly. Like they are receiving late and then giving late. So we need to know why they are not able to pay. Sometimes this number, like, so if I can pay my vendors much later, it is a good competitive advantage, because I can use that money from somewhere else and I pay him 6 months later. But why, if I am doing that because I'm not financially doing well, then it is a very bad sign. So we have to see what is happening here. So generally, I always see trade receivable minus trade payables should not be very high in comparison to the profit of the company, right? Trade receivable, like um, a profit or sales, any ratio you can link and then compare that. Then yeah, EV to market cap is also like I put this ratio myself because it very quickly tells that the company has debt or company doesn't have debt, right? Because EV is market cap plus debt minus cash, right? So here this company has cash, and this company has debt, this company has debt, this company has more debt. Yeah, asset
This
turnover ratio. Yeah,
TCA is given a return for 5 years, return 29% only, 29.5%.
yeah, 30, almost 30%. And this has given like 40. So it is CAGR.
So, Manish sir, I have one question actually.
Yeah.
Whatever you showing, this is a past record which is showing the company, correct?
Yes.
Current situation of the company. So how we will look next 5 years, or how to invest like that, sir? Like forward PE like that, sir? How to understand?
Yes. Okay. So yeah, let me complete it here. Then we go back. So this is 1.64 is the turnover asset turnover ratio. So here probably it is not that big important. It is not a manufacturing kind of company because whatever they invest money, it is little long term. Then free cash flow is also, if you see here is a strong free cash flow, and here it is basically, if you see, is they are all similar, and then you have to look at the market cap, free cash. So market cap to free cash flow, you'll have to see. So this is the so now we go back to the slides, and here I would say that so because of, so these ratio are easy to analyze, but everywhere when you get the question, it is very difficult to basically go and explore the answers for that, and that is where the most of the time goes. So like just now you said that the future, to understand the future is also another thing, very you need to have is what is it called, un- like in-depth understanding of the business, right? So when I invested in this company in 2009, I believe, or 10, right? Then I took almost 2 months to make decision on this. uh, so at those time we did not have a screener. I think screener had just come in, I did not know. So I had to go and look at through money controls, look at all this data, and get all this data, and try to understand a little bit whatever we just see in one shot. So that also took a lot of time. Then I looked at the interviews of this guy on TV. So there's the MD is Vineet Agarwal, and he was very young and very down to earth person, and this guy has huge clarity on the business, huge clarity. Then and on YouTube I searched some more. So he has a master class on this business, and that is 1 hour master class. I see that, and there are some other classes also he has. So I was very impressed with that person. So the way that guy was talking, it seems to me like like mini Aditya Puri of banking, right? Like Aditya Puri is for banking, is the clarity he has on the banking concept. Like I have never seen anybody like that, like Aditya Puri. Same for logistics, this guy had. So that gave me a lot of confidence. And then he himself will tell. So he told that concept that if the GDP is at grows at 7%, our sales will grow at 14%, and our profit will grow at 28%. And he will tell, okay, our freight business, the ROC is 15% is a good number, So a lot of things these guys tell in their own con call, in their own interviews, in their own what is that called, uh, question and answer sessions of the con call. And if you want, you can read their this management and discussion section of this annual report. So you can also see that. So 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 at that time the trigger was were there. So one trigger I know was going to for sure happen was GST. So if the GST happens, then these guys can bring a lot more efficiency. So more detail you can find how the GST affects the logistics company. Somewhere you can find on internet, right? Then the second thing, these guys were spending significant time on the roads. So I know the roads are going to improve in future, and that I am tracking that how closely the roads are built in India, right? So that affects the efficiency of logistics company a lot. Like this guy is coming on interview and saying that each check post is like taking away 30 minutes of time on an average for each truck for him, right? So now I know that if FASTag comes, this will go away and turnaround time will improve. So turnaround time from Delhi to Calcutta for a truck, which used to be like 7 or 8 days, it comes down to like 2 or 3 days now, because all these FASTag, and so this was all in future. But I have to have faith that like which will happen, which will not happen. And when I take consider, so based on the matrix he gave, that if the GDP grows at 7%, their profit will grow at 28%. If their profit will grow at 28%, their share will also grow at 28% roughly, right? So and that is on 7% GDP. My estimate at that time was that GDP will grow at 8 to 10%. So when I put that number, it is automatically more than 10x in 10 time valuation. It was actually coming something like 20-25x in 10 years, right? And it did more than that. It is like 45x right now for me. So it exceeded the expectation because GST also happened. This guy delivered very, very well. And so this guy basically split the company in TCI Express, and now TCI Express his brother runs it, right? So every parameter, I think he exceeded the expectation. And so of course, like um, my estimates were more or less okay. But what point I want to make, that when I was buying this company was 57 rupees, right? And that has TCI Express, TCI Developers, and TCI, all three in that company. And I did not give too much money for what future it would be, right? Like even if those things would have not happened, this would have still done 10 to 15% kind of return. That is what my take was, that I do not like to give too much money for the future, what future would be, right? So if future doesn't happen, where I would be, that also I have to know. So that was already in, right? Any other question?
Clear, sir.
Okay. So now similarly we're going for automobile business, let's say, right? So what I have to look at in automotive business is market share trend is very important for me, right? If market share, if how the market share is trending for the company, and what is the perception of the brand in the community, like these two things I have to look at very, very, very closely. And then EV/EBITDA, for comparison between the companies, you look at EV/EBITDA, market cap to sales, and like if they have any debt issues, like from those ratio you can find out. And again the same thing, like you will find some anomalies in between, and then you have to find the answers why it is like that, because market knows a lot, right? So it may be something I am missing, right? So just to be sure that I am not missing that, it is market which is missing, it takes significant time and effort to validate that. So then going to the banking business. So why I want to invest in banking business? There is a constant demand for the services, like everybody needs money for their business, and they want on interest, right? And then very strong supplier side franchisee. So bank is a very nice business in this sense, because here your supplier comes and gives you money, and then you pay a little bit money to him and then make a lot of money on his money, and he doesn't ask any question, right? So like we as a depositor, we go and give our money to the bank, and then I think in Singapore or in other countries it doesn't give any money. In fact, they take away some fees also, and and they make 3 to 4% in Singapore, and in India they make like 15% on your money. And depositor is like very happy. They treat the depositor like if they are the beggars. They will not treat you very well, but still you will go and keep your money in SBI, keep your money in ICICI, right? So very strong supplier side franchisee they have. And then high risk business, but the risk can be distributed easily. So here what I mean, like, because if you give somebody your money, you are taking a lot of risk that he will return the money back, right? So that is so in this sense it becomes, because it just goes out of your hand, right? So it becomes very high risk business. But if you say that instead of giving my money to only one person, I will give to 100 people, and I will divide my money in 100 part and then give it to 100 different people, make sure my one client is not more than 1%, then you distribute the risk, because you know that out of 100, if my process is correct, at least 95% people will return my money. So that is where you manage the risk. So in banking, these two things are only very big. Like if you know these two, 90% of the thing is done. From whom company takes money and whom does it lend to, right? So like NBFCs, you know that they take the money from the banks, they know they from corporates, from some big guys. But banks are very good. They take money from small guys like us at very low cost. Whom do they lend to? This is where the difference comes, when it is Yes Bank and HDFC Bank, right? So S Bank was lending money to crony capitalist people, right? Some other PSU banks were also doing that. And it doesn't take a lot of time and effort to find that out. But still, like I think that initially I was investing in some PSU banks, and I did not know that these banks were lending money like the companies were bribing them, and then they were lending money to the crony capitalists. So it is like in that sense it becomes better, like to go consumer facing banks. Like there are some banks which they say, oh, I like to give money to a small consumers, a small businesses a lot, like those. So that distribution we need to spend time. So initially I never, like that was one big fault when I was investing in banks. I was not looking this first. It was a big mistake from my side, and I lost a lot of money in Andhra Bank. And yeah, and there was one more, I think it was not the bank, but it
Arun
is
Vaishya Bank.
no, Karur Vaishya is okay. Is like they did not make much money, so I just got rid of it. It was NBFC type of thing, so it does not coming. It doesn't come to my mind. But it was again, yeah, Central Bank of India. Central Bank of India. It's like 200 rupees, and now I think it's still, when it is up so much, it is like 20-25 rupees. So because I was looking at only this second thing, price to the adjusted book value. Okay, oh, this price to book value is less than like less than 0.25, less than zero point 0.2, and then that price to book so book keep on revising, becoming a smaller and a smaller price was becoming a smaller even faster, and this ratio was just keep going down. So it was interesting. then then this parameter also I look at, uh, total business to book value. So like if the bank, so how does bank make money to, what is the business model of the bank? Like bank will go and borrow money from all these people. Let's say they, like I go and open a bank, and then there are multiple, like thousands of people come, and they give me 1000 crore rupees. Okay. And then so that 1000 crore rupees, there is a limit, it seems, how much I can take from other people. Like there is a ratio they have to be within. Like if I have the one, I put my 100 crore, then only I can take 1000 crore from other people. It is not like I put 100 crore and I go and borrow 10,000 crore from other people. You understand, right? So every bank has its own money, and then from there they take the depositor money. So now so there I have 100 crore, and I take 1000 crore from the depositor, so it becomes 1100 crore. On this 1100 crore, I lend like 800 crore on interest. 300 I still keep, because some of these guys will come and say, "Hey, give me my money back." So I should be able to pay them, right? So 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 what some of these banks, which are called like very safe bank, they can get into it, is very like they take a lot of money, but they don't lend enough money, right? They are very conservative in lending, like not lending, just keeping the money tight. So their profit will be, so later you will see that their profits are affected, right? So conservative banks, like they don't go under, but they don't make money also. So I want, like if company has like 1000 crore rupees, I want them to basically lend that, right? That also I will look. So these two three things in the bank. So if I know these, I can just compare, and still I can look at other parameters. But like if I know these things, very likely 90% of the decision is made here. Okay. Now maybe take oil companies. So oil company, why I want to invest? Because it is a very difficult to execute business, need large capital, and that is its moat. Okay, so this is the oil company. So a lot of people work here in oil companies, so we can know this. We know this thing. And for oil companies to evaluate and compare, I just need two things: how much oil reserve do they have? So I'm not talking about downstream, just oil companies, the upstream oil companies, and then the company's track record in executing the project. So I have like a 1 billion barrel of oil underground, explored and ready for me to take out, and how nicely I can take out. That is the deal. Because here the market is like constant sea. There is the demand is constant. It is not like you can gain market share and you can reduce market share. Your price is also decided by the market, so there is no control on that side. So that part is, as long as you bring the oil, you cannot store it. Whatever price it is going, and you have to sell it. And so that part is no point in looking at. So we have to look at how much oil I have, and how nicely and how efficiently I can bring it up and sell it. So executing the project is the big deal there. So most of the companies which were affected were because their capital investment decisions were not good. Like they either they invested
ONGC.
huh?
ONGC, sir.
Not ONGC is I'm talking about even oil companies worldwide. Like they went and did like few $100 billion project, and then all their analysis was not good. Like they said, oh, the oil will be $100 for next 40 years, and their calculation were based on that. But then oil become like $40 for for 10 years. and then their value of those like hundreds of billion-dollar project became zero, negative actually. Their NPV became negative. So for next few years, they did not make any money. So that is where the, like track record of capital investment is very important in our company. So ONGC is also like that. ONGC is not a great company. It's like it was trading at 3 PE last year, PE of 3, which means like the whole market is, and ONGC you cannot say it is under discovered stock. So it is a very popular stock actually. So and then still it is market is giving 3 PE. That means market think that this company is going to be terminated. It's like terminal value. It was trading at terminal value. Okay, so now moving to the next one, life insurance business. So why I want to be in this business? So because this service will be increasingly be needed by the society, so that we know very well. In India, insurance penetration is very low. So it is huge potential to grow from here, right? And business is also, insurance is always very high mode business. I cannot open my insurance company today, right? Is very high mode business. So here I like knowing this embedded value concept helped me last year when I was looking at this. So I was comparing, let's say ICICI has insurance business, ICICI Blue, I think, and they have,
Prudential.
and SDFC Life is there, SBI Life is
ICICI
there.
Prudential.
Yeah, yeah. So all these three companies were the main life insurance company I have. I was comparing, and I know this concept of embedded value. This is very important for life insurance company. How much embedded value company has, right? So when I compare, SDFC was more than 6 times trading, 6 times of embedded value, and this ICICI Pru was also around 5 to 6, and SBI Life was only 3. So I invested on SBI Life, and it was like only 3 times of embedded value. So
Yeah,
embedded
if
value
I
is,
understand.
yeah,
See, even you are invested in SBI. See, the insurance, the whatever they are giving back to the customers also, it should be good, right?
yeah, it is like you are saying that the claim ratio.
Yeah, claim ratio, yes, sir.
Yeah, so claim ratio actually, so if I am an investor, right, actually claim ratio, if it is lower, it is better for me, right? That means company is very highly basically company is rejecting like let's say claim ratio is like 92%, right, versus claim ratio is 99%. So claim, as an investor, as a owner of my of the company, lower claim ratio is better because company is rejecting 8% of the claim. But if that is affecting company's brand value, which means they are not gaining the gaining gaining the market share, that is not good, right?
So in this case, why we are not invest LIC, sir? LIC, because they are
LIC is
the
not
one
trading,
holding.
right? LIC is not trading yet. So LIC IPO is going to come. And so once we know this concept, the benefit is now IPO is going to come, and somewhere the news report is saying the embedded value of LIC is 5 lakh crore. So I know that if LIC IPO comes at 15 lakh crore or lesser, I would be interested in the IPO. But if it will come higher than that, I know how much richly it is valued. So that also like in IPOs, when these IPO come, I find like all the information missing, and there is no track record. So knowing these concepts also help.
Manish, sorry,
Yeah.
can you, if possible, quickly give some insights on embedded value for insurance business? I mean, what it really means.
Embedded value basically, if you go and look at, probably in internet they can explain better, but generally what happens, there is a authority, IRDA or something, insurance authority in India, which gives a formula how to calculate the embedded value. So company cannot itself come and say that, oh, my embedded value is this. So to understand that, it will take a little more time, but what, on high level I can tell, like if I have paid, well, let's say I have 100 insurance, I have 100 guys, right? And they have given me, let's say, 100 crore rupees for their life insurance, right? Based on their age, and in India, there is a mortality profile, and based on that, the government provides them what is the possibility of these people dying, in, let's say, next 1 year, next 2 years, next 3 years. So there is a possibility. So only way I would be able to basically pay them if I have collected more, right? So if I have 100 crore rupees collected from these guys, and let's say that possibility of claim is only 20 crore, then 80 crore becomes my embedded value. It is something like that, but exactly you can search on internet. So because, like, I can take 100 crore and go and insure a lot of 95-year-old guys, but then my embedded value would be very less, because I have to be ready for their claim, because I am basically insuring the high risk individuals, right, at a lower price. So what it tells, higher embedded value tells that the company is basically, like how much, it depends on the volume also, and then how much the money company has, and how much it is, basically there is a chance it will have to pay. Okay, so that is basically a value in store for the company, and then how much you are paying. So embedded value is a good ratio for insurance company, but this only for life insurance, not for general insurance. So general insurance, you have to take more like a mutual fund or those kind of companies, and then probably embedded value will go out of the picture. But I think value of new business and then the expense ratio, those things will be the key. Like uh, uh, total expense ratio is there, you can say, and then, yeah, there the key will be how much money they have collected, and on that how much money they made, right? The total investment value, how that is increasing, the track record, because the general insurance company make very good money. They make much better than mutual fund, because they don't have to, like, nobody can redeem that money just like that, right? Your money is locked in, so they have a lot of freedom to invest long term. So the track record of their investing and the results from there, that would be for GIC and New India Insurance and ICICI Lombard, for those kind of companies.
Okay, great.
Okay, and then the growth rate, how they are growing their business, perception of the brand, like so like for India, like if LIC comes and LIC is trading at 3, and then the other company comes that is also trading at 3, I will go with LIC, right? Then say construction business is like very rewarding business, but it has cycles, right? So, and then asset light models can be very profitable at low risk, right? So this construction business, so currently it is very relevant, because if you look at the results, look at the budget, they have put a lot of money for capex. So capex cycle, which was down for last 10 years, it is going to come up, right? So if you don't want to do much analysis, just go and buy L&T and BHEL, the market leader. But if you want, then the best thing is to look at the order book to sales, how much order book they have, right? Then track record in executing projects, then how much receivables and debts they have. So what happens, a lot of time these construction company don't do well when because they are very large client, and if a large client doesn't pay money, they that becomes a big problem, because if it doesn't pay money for 3 years, all these construction company, they take the money at very high cost, and if the client doesn't pay for 3 years, the interest can kill them. So receivables and debt, how they are distributing the receivables and debt, and how they are able to recover the receivables is very important. Like there is a saying in construction business that if you pay after 3-4 years, like payment is zero, that whole thing is lost because their interest rate is very high. Okay, so that is for construction business. Yeah, I think that's all I have, and then any other businesses we can talk, if like I can explore if I don't know. Means we can cover some other time some other businesses also.
Well, thanks, Manish. Excellent session. Really, it's very deep into the way we can live into analyzing companies. Anyway, we can leave the floor to open any questions from the participants. Any burning questions you have on what Manish has taken so far?
Yeah,
Manish,
yeah.
Sarah here, right?
Yes, Sarah. Yeah.
So you are saying for even though there are some general trends for each companies or each group of companies, right?
Mhm.
Cluster of companies. It's best to listen into the CEO or their annual or even the quarterly meetings,
Mhm.
how they measure their businesses and how they are comparing their own growth.
Mhm.
That would give you the clues to really get to that one or two parameters right critical to that industry. Am I correct?
Yeah. Yeah, normally if I want to learn the business, those are the best guys to learn. Means like, and a lot of managements are not good at teaching, but some people, they themselves want their investor to know how their businesses work. So it is very helpful if they explain themselves what they are getting at. And if you look at their question answer session, then the way the questions come, you know where the problems are, which they will not say in their earning report, they will not say in their presentation. but but analysts will ask question, why this thing is not happening, why that thing is not happening, right? So if you, I think 1 hour of listening to their earning call is very helpful. Is very helpful. Yeah, but what happens sometimes some people can find it very boring, but I often find the earning report much better than even the TV interviews, because TV interviews, they always ask question, try to get the headlines, but in earning report you will find sometimes very angry analyst because he recommended the stock and then the company did not deliver, right? So sorry, so you will know where the problem is, what are the difficulties, what are the key challenges each company is facing, right? Like and they themselves tell, a lot of times they tell, because the management has its own KPIs, right? So they will not tell what is their target KPI, but they will say, okay, I am tracking this, like our EBITDA should be in this range, and I think we are within this range. And then they will say, like they will make a statement that we are investing, this should be online, this plant will be online and it will be profitable in next 8 quarters, right? So then you know, okay, so this big plant, roughly it takes this much time to be profitable, right? So then when some company, a news comes that, hey, I am going to put 1,000 crore plant here, and then this would be basically online at this time. So you know that, okay, so should expect a dip in the earnings for after some time. So basically you can decide, like when the earnings are coming, then you automatically expect that there would be a dip in the earning, right? So all those things help.
Thanks,
Manish
thanks.
sir,
Yeah, yeah, please.
Manish sir,
Yeah,
Raja sir.
yes, please.
Sir, I would like to understand. See, last 2 days when I seeing on YouTube on for my on stock view. See, how you seeing on the FS investment, sir? Like some stock they sold. Like I seeing some we are some logistics company only. I'm just seeing go through. Last 3 months they have increased on the FS from 3% to suddenly 8%. How the stock will impact on this, sir? Like how you will see? You will see the importance on the FS on the stock or not, sir?
No, so FIIs are, I think, most stupid share holders in our Indian stock market. So if you look at any FIIs, basically, if you look at the trend for last 15-20 years, if you would have bought, like if you entered the market with FIIs and exited with FIIs, you would have made negative returns, right? So so if you look at the FIIs when they are buying, so if it is an individual, then I can see, like I respect a lot of individuals like Rakesh Jhunjhunwala, Sunil Singhania, and and Vijay Kedia,
Radhakrishnan Damani.
yeah, Radha Krishnan Dhamani, and I literally consider Ramesh Dhamani as my guru, because initial period he used to have chat sessions on money control, and I used to attend those. And he is the one who instilled the concept of market cap in me. He will always answer the question in market cap, and always answer the question in pat, always answer the question in the as a company, like owner mindset, right? So if these people have invested, then I pay some attention, okay? But that doesn't mean that, oh, if this guy buy, I am also buying, because I'm not convinced. And some more, if these famous people buy some companies, the stock, as soon as the news comes or even before, it becomes very expensive. So it is best that if I buy something and later they buy, right? So I tell you, like there are three companies, like HIL, which I bought in 2010, and ADF Foods, I bought in 2015-16, and Acrisil I bought last year. And these three stocks were bought by Sunil Singhania after that, and all three have become like 10x from that time. So I benefited because I had already bought them, right? But if I would have bought after they bought, it's very difficult to basically uh, make money, because it is already reached to a saturation point for the for the near future. Same way, if they are selling, then obviously it doesn't make any sense, because if they sell, the stock is dumped and then the stock goes low. But then you worry that, okay, if this guy is selling, he's a long-term investor, he doesn't sell just like that, right? So there should be some problem in the company, right? So it's very difficult to go and take a stand against that. So what I do, I listen to all these people, look at what concepts they are talking, but don't just go and pick their stocks.
Noted,
You
sir.
understand, right? So same is
Yeah, yeah.
FII, is just don't look at them. DIIs are much smarter than FIIs. So if, and some more, like if there is a company which is like a full of DII and FIIs, right? The volatility is also very high, and it is always better that you buy before they buy. If it's already saturated, then you are buying, then there is no benefit. So I would say that promoter holding, definitely it's very meaningful data for me. But FII and DII just tells that it is not under discovered stock. If FII holding and DII holding is increasing and it is high, it just tells it is not a under discovered stock. And I look at under discovered stock. right? I want under discovered and under owned stock. So that then it becomes a little bit minus point for me.
Noted, sir.
Yeah.
Okay,
Yeah.
it's almost 1 hour and 45 minutes,
Yeah.
and we can see that Manish is keep on talking, and he started coughing. So let us give it some
Yeah. No. No.
break.
No problem at all. Yeah. Very interesting
Yeah,
topic. We can talk hours for that.
yeah, exactly. It's non-stop, right?
Yeah.
Because we have a lot of things that
Uh,
comes up when we have these discussions.
uh,
So, anyone have any quick reflections, feedback on this session? We can still have a Q&A in WhatsApp group. You can put your questions, or like Manish earlier offered,
yeah.
you can have some chat with him,
Mm,
provided he has time.
yeah.
So, yeah. But any quick reflections, feedback about the session from the participants? I see something in the chat box. Good.
Thank you, Manish here.
Yeah.
Raja here.
No. No problem.
Yes, yes.
Yeah.
Thank you for your support and sharing the valuable time and your experience to take it forward. It's useful as like I have a few view on the stocks like FIS investment. I will see basically
Mhm.
like I will go through on this. It is an important parameter where I investing on the stocks. So what you're telling now, see, it seems like a sector wise what value we have to invest and how to invest on the stock. It give us a clarity on the stock by investment also.
Yeah.
Thank
Yeah.
you, Manish sir.
No
Thank you,
problem.
Srinivas sir.
Yeah. Thank you. Okay, yeah, I think that's it. So yeah, what we can do is basically keep on having the discussion through the WhatsApp group. Feel free to put any note there, and then I see some people can reply with some article or something. So that also helps. And anytime we can discuss this.
All right.
Okay.
Great session. Thanks everyone for the participation, and special thanks to Manish. All right.
Okay.
We can
Thank you.
stop
Thank you, everybody.
recording.
Yeah.
Thank you,
Thank you,
sir.
Manish. Yeah,
Okay.
good.
Yeah. Bye.
Thank you, sir.
Yeah. Stop. We stopped recording, right?
Yes, Manish, please.
Okay.
You have to do that.